I think fundamentally why this idea of acronyms is an important thing to understand is that most of the time communicators and hearers are not hearing and understanding, and not communicating and understanding at the same level. Because finance is the language of business, it's actually unfortunate that it's not very clear. For example, there are lots of ways to describe the same financial concept. Net income, net earnings, net profit, profit for the year, the bottom line. Those are all expressions of the bottom line on the P&L. That's confusing. It would be better if there was just one name for what that is. The statement of income, the P&L or profit and loss statement, the statement of operations, the statement of earnings. Those are all different financial names for the same financial statement. Why are there multiple names for the same financial statement? I have no idea, but it makes it way more complicated than it needs to be. So I think understanding the definitions, understanding the language of business will help you. And regardless of how somebody communicates it, I think it's important for you to understand what it is they're talking about, at least fundamentally. So that's actually a premise, I think, why this acronym conversation that you're having is really valuable, because I think people are wildly disconnected from it. Finance is needlessly complicated. It's needlessly, we confuse people for no reason. And you know, I mean, maybe there are reasons why, but I actually don't know what they are. So there's a couple acronyms on this list, so let me just talk through one. The Financial Accounting Standards Board, FASB, you will hear that referred to in the market, is the governing body for financial reporting in the US. And it creates the GAAP metrics, the generally accepted accounting principles that organizations use for their financial reporting. IFRS, or the International Financial Reporting Standard, is FASB's peer in the international community. Outside of the US, organizations use the IFRS, or the International Financial Reporting Standards, for governing their financial reporting. There are nuanced differences between FASB and GAAP and IFRS accounting, but that's those are the basic definitions for what they are. That there are unique differences between the standards. I actually think it's dumb that we have standards. It's metric versus standard, right? Why does one part of the world do it a different way than they do it in the US? I don't know. When an organization looks at its profitability, the first thing we look at is their revenue or sales. And are there costs associated with generating revenue and sales inside of organizations? Of course there are. The first bucket of costs that we look at are the cost of goods sold, or COGS is the common acronym for this. The best way to think about these costs, these are the direct costs associated with getting product or services ready for market. And in manufacturing organizations, it's the cost of raw materials, manufacturing operations, supply chain and distribution. In a service firm, like a law firm, it's the attorneys who provide the services. In a hospital, it's the nurses and doctors who provide the services. They are the direct costs for the products or services that an organization sells. When you subtract those direct costs, the first profit metric you get on the P&L is often referred to as gross profit. The direct costs are not the only costs associated with running a large organization. The next bucket of costs that we look at is often referred to as SG&A. It's an acronym for the selling, general, and administrative expenses. You might hear these sometimes referred to as overhead. I don't like that expression because it has a negative connotation, but literally it is the overhead associated with running a large company. In there is all of the sales, marketing, advertising, the commercial effort for getting their organizations to market, their products and solutions to market. The general and administrative are all the support functions, HR, finance, legal, IT, audit, the corporate executives. All of that goes into the selling, general, and administrative bucket, often referred to as overhead in the organization's business expenses. Capital expenditures is how we account for the buying of property, plant, and equipment inside of an organization. Capital expenditures are the buying of property, plant, and equipment. Capital investments that a company makes in order to develop products, expand their business, and so forth. One more metric I'll share with you. The cost of goods sold, the selling, general, and administrative expenses are operating expenses. When you subtract them, the next profit metric you might look on the P&L is operating income. Some companies call this operating profit, some companies call it operating earnings. It is often referred to as EBIT, the earnings before interest and taxes, or the company's operating profit. Another financial metric that comes up from time to time is EBITDA. That is the earnings before interest, taxes, depreciation, and amortization. The way we calculate it, we simply take the operating income or the EBIT and we add back the DA. That's really dumb, but that's how you do it. That's how you calculate what it is. Organizations that have lots of capital expenditures use EBITDA for two fundamental reasons. One is the closest profit metric to the concept of cash flow. Two, it holds people accountable to the things they can control, the revenue or sales, the cost of goods sold, or solutions provided, the SG&A, and pulls out things that are difficult to control, the interest, the taxes, the depreciation, the amortization. Most people in an organization don't feel like they have much control over their interest expense. They don't feel like they have much control over their taxes or income taxes. They don't have much control over the depreciation or amortization expenses, so it holds them accountable to the things they can control while pulling out the things that are more difficult to control. Organizations that have lots of capital expenditures use EBITDA as their profit metric.